You might have heard about the stock market indices like the Dow Jones, S&P 500 and Nasdaq Composite in financial news or in normal conversations about stock market. In today's video we will find out what these names indicate. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex and many more. So watch this video till the end and hit the subscribe button and click on the bell icon to get notifications for our future videos. So let's begin the video. What are stock market indices? A stock index, often known as a stock market index, measures the stock market or a portion of the stock market and aids investors in comparing recent stock price levels to earlier prices to determine market performance. This helps the investors to understand and compare the performances of the stocks they own. There are hundreds of stock market indices around the world, like the DAX, that measures the performance of 30 major German companies' stock in Frankfurt Stock Exchange, and Nikkei, which measures the performance of 225 major companies in Japan. The three primary indices on the US stock market are the Dow Jones, S&P 500, and Nasdaq Composite. Let us learn about them in details. Dow Jones Industrial Average, DJIA. The Dow Jones Industrial Average, also referred to as Dow Jones, or simply the Dow, is a stock market index of 30 prominent companies listed on stock exchanges in the United States. It was created by Charles Dow, the editor of the Wall Street Journal and the co-founder of Dow Jones and Company, and named after him and his business partner, Edward Jones. It is a price-weighted index of 30 large, major, and active U.S. stocks. As it is a price-weighted index, it is represented by a single large value that changes depending on the movement of the 30 stocks. But all the 30 stocks do not have the same influence on Dow. As it is a price-weighted index, the stocks with higher prices weigh more heavily on the value of the index. For example, a price change in a $200 stock will have more effect on the value of the Dow compared to the same price changes in a $100 stock. It includes blue-chip stocks like Apple, Nike, Coca-Cola, McDonald's. The Dow is not just a straightforward calculation, though, as corporations may have their shares split, merge with other businesses, sell off a portion of their operations, or even have their names removed off the Dow. The Dow divisor is used to divide the total price of all 30 equities in order to generate the Dow Jones Industrial Average. In the event of stock splits, spin-offs, or other structural changes, the divisor is changed to guarantee that these occurrences do not by themselves impact the Dow's numerical value. The Dow is criticized for being a price-weighted index, which overlooks the relative size of the industries or the market capitalization of the constituents, and gives more weight to higher-priced companies than to lower-priced firms. The Dow is a highly monitored index since it shows the performance of the shares of some of the biggest U.S. corporations. Many people believe that the Dow Jones Index is useful for gaining insight into the performance of the U.S. stock market overall, because it comprises leading U.S. corporations from a variety of industries. Many experts consider it to be a poor representation of the entire U.S. stock market when compared to a larger market index, like the S&P 500. While the S&P 500 measures 500 significant U.S. corporations, the Dow only measures 30 of them. S&P 500. The Standard & Poor's 500, also referred to as the S&P 500, The S&P 500 index is a free-float weighted or capitalization-weighted index that monitors the stock performance of 500 notable companies with U.S. exchange listings. It is one of the most frequently followed equity indices. The 500 largest and most influential U.S. stocks listed on the Nasdaq and New York Stock Exchange make up this group, which was founded in 1956. It includes well-known equities like Microsoft, Apple, Johnson & Johnson, Facebook, Amazon, and others. The weights of the firms are established by their market capitalizations because the index is capitalization-weighted. When determining a company's market capitalization for index weighting, only shares that are traded publicly are taken into consideration. Shares held by controlling shareholders or insiders that are not traded publicly are excluded from the computation. Companies with a higher market capitalization weigh more heavily in the index. A price change in a stock with a market capitalization of $50 million will have a greater impact on the value of the S&P 500 than a similar shift in a stock with a market capitalization of $25 million. The components of the S&P 500 index are chosen by a committee. Market capitalization, liquidity, domicile, public float, the global industry classification standard and representation of the industries in the U.S. economy, financial viability, length of time being publicly traded, and stock exchange are the 8 main criteria the committee uses to assess a company's merit when determining its eligibility for a new addition. Over the past few years, fewer S&P 500 companies have maintained classified boards. A few prerequisites to get added in the index are: market capitalization must be greater than or equal to $14.6 billion US dollars. Annual dollar value traded to float-adjusted market capitalization is greater than 1.0. Minimum monthly trading volume of 250,000 shares in each of the 6 months leading up to the evaluation date. Must be publicly listed on either the New York Stock Exchange or Nasdaq. The company should be from the U.S. Securities that are ineligible for inclusion in the index are limited partnerships, master limited partnerships and their investment trust units, OTC bulletin board issues, closed-end funds, exchange-traded funds, exchange-traded notes, royalty trusts, tracking stocks, preferred stock, unit trusts, equity warrants, convertible bonds, investment trusts, American depositary receipts, and American depositary shares. Since 2017, companies with dual share classes are not added to the index. It is being used by both individual and professional investors in the U.S. to gaze at the performance of their own stock. In 2021, the index closed at a new record closing price for 70 consecutive days, becoming the second highest number ever recorded, the first being the 77 closing highs recorded in 1995. This was also the first year since 2005 when the S&P 500 was able to beat the other 2 closely monitored U.S. stock indices, the Dow and the Nasdaq Composite. Nasdaq Composite Index. This index was introduced in 1971 with a beginning value of 100, making it the youngest one of the 3. Almost all of the stocks listed on the Nasdaq Stock Exchange are included in it. Being a capitalization-weighted index, the Nasdaq Composite's price is determined by adding the closing prices and index shares of all the securities included in the index to be eligible for inclusion in the Nasdaq Composite. A security's U.S. listing must be exclusively on the Nasdaq stock market unless the security was duly listed on another U.S. market prior to 2004 and has continuously maintained such listing. Additionally, the security must be one of the following security types: American Depository Receipts or ADR, common stock, limited partnership interests, ordinary shares, real estate investment trusts or REIT, shares of beneficial interest or SBI, tracking stocks. The index does not include closed-end funds, convertible bonds, exchange-traded funds, preferred stocks, rights, warrants, units, or other derivatives. A component security gets taken out of the index if it ever ceases to satisfy the necessary requirements. We may conclude that these indices not only help us to track the market but also offer investors great opportunity to invest in the market through exchange-traded funds or ETFs, which are precisely what their name implies: funds that trade on exchanges while typically tracking a particular index. When you purchase an ETF, you receive a collection of assets that you can buy and sell during trading hours, potentially reducing your risk and exposure while assisting with portfolio diversification. Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.